Yesterday afternoon, I got a message from a contact, someone I've known for about 2 years. He's in industrial procurement for a manufacturer in the Midwest. The message was just 3 sentences. We can't get a quote. Nobody's answering. Even the backup channels are quiet. And that was it. No explanation, no follow-up. Just silence where numbers used to be. I sat with that for about 20 minutes before I started making calls myself. And what I found wasn't panic. It wasn't a sudden price spike or even volatility. It was absence. And if you've been watching markets long enough, you know that absence is often louder than any headline. Let me walk you through what happened, what didn't happen, and why the thing that didn't happen might matter more than anything you will read on a financial terminal this week. It started with an announcement from China's State Administration for Market Regulation. They published a directive that barred 44 companies from what they called irregular market coordination activities related to silver. These companies cover refining, fabrication, and distribution. The language was bureaucratic, the tone was administrative, there was no drama in the text itself. But what happened next is where the real story begins. Within 6 hours of that announcement, I watched the bid-ask spreads on physical silver contracts in Shanghai start to widen. Not collapse, not explode, just widen. Now, this is a subtle thing, but it's a huge signal. It tells you that someone or some group has stopped providing liquidity, they've stepped away from the market. By the next morning, it got even stranger. Certain contract months weren't pricing at all. You could see a number on the screen, but when you tried to transact against it, nothing moved. It's like watching a heartbeat monitor go flat while the patient is technically still alive. The system shows a pulse, but there's no actual blood flow. So I reached out to another contact, someone who works in metals logistics. He's the guy who physically moves material between vaults, refineries, and ports. I asked him what he was seeing on the ground. He told me his system showed available inventory, but when he tried to lock in tonnage for a client, the confirmation never came back. He said it felt like the valve had been turned off, but nobody had bothered to update the pressure gauge. And that's when I started to understand what was really happening. Thought. Why the silence matters. Silver doesn't move like gold. It's not a reserve asset. It's not held by central banks in the same way. It's an industrial metal with a monetary history, which makes it strange. It sits in a category that most people don't think about until it's not there. Solar panels need it. EVs need it. Electronics need it. And about 60% of annual silver demand comes from industrial applications that can't substitute it out without retooling entire production lines. China refines roughly a third of the world's silver. But more importantly, Chinese entities control a significant portion of the logistics, warehousing, and forward contract infrastructure that allows the rest of the world to access that supply. When you see a price on your screen for silver, you're not looking at the metal. You're looking at the agreement that someone will deliver the metal to you under certain conditions at a certain time. What happens when the entities who facilitate that agreement are no longer allowed to coordinate? You get what we're seeing now: prices that don't move, quotes that don't populate, contracts that exist on paper but can't be executed in reality. I want to be very clear about something. This does not look like a market discovering a new price. This looks like a market being told to stand down while decisions are made elsewhere. Containment versus discovery. There's a theory in market structure that says real price discovery happens when participants are free to express their view through action. They buy, they sell, they hedge, they arb. The price moves because information is being processed in real time by people with capital at risk. But there's another kind of price action. It's what happens when someone with authority decides that discovery is inconvenient. They don't ban trading. They don't halt the market. They just remove the participants who make the market function. The price still prints, the chart still updates. But nothing real is happening behind it. What we're watching in silver right now feels like the second thing. On the day the ban was announced, silver was trading around $74 on most exchanges. It had been climbing steadily for weeks, driven in part by supply concerns, in part by renewed interest in hard assets, and in part by tightness in the physical market that had been building since late last year. Then the announcement came, and the price didn't crash, didn't rally, it just froze. I checked futures volumes. They were lower than normal, but not dramatically so. I checked options flow. There was activity, but it was defensive. People rolling positions, people flattening. Nobody was pressing. And here's the strange part. Nobody was defending either. It's like both sides of the trade just stepped away from the table at the same time. That doesn't happen by accident. I spoke with another contact yesterday. He runs a small fund that takes physical delivery on precious metals. He doesn't trade paper. He takes possession. His process is simple. He identifies a contract. He funds it. He takes delivery. He vaults it. It's been working the same way for 15 years. 2 days ago, he tried to take delivery on a silver contract in Shanghai. The counterparty acknowledged the request. The paperwork was filed. The settlement date was confirmed. Then nothing. No metal, no explanation. Just a message saying the delivery was delayed due to administrative review. He escalated. He called his broker. He called the clearinghouse. He called his lawyer. Everyone gave him the same answer. The contract is valid. The obligation is clear, but the metal isn't moving. He told me he's not concerned about the money. He's concerned about what it means when a contract stops being a claim on something real and becomes a claim on a promise that may or may not be kept. I asked him what he's doing now. He said he's waiting, because that's all he can do. The contract says he owns the metal. The system says the metal exists. But the metal isn't in his vault, and nobody can tell him when it will be. This is where the theory breaks down. A futures contract is supposed to be a transparent, fungible, enforceable claim on a commodity. But transparency requires disclosure. Fungibility requires access. And enforcement requires a legal system that treats contracts as binding regardless of who holds them. What happens when one of those three conditions disappears? The contact I mentioned earlier, the one in procurement, sent me another message this morning. He said his company has a production line that requires a specific grade of silver solder. They've been sourcing it from the same supplier for 8 years. The supplier buys refined silver from a Chinese distributor and fabricates it to spec. The order was placed 3 weeks ago. It should have shipped last week. It didn't. When my contact called the supplier, he was told the distributor couldn't fulfill. Not wouldn't, couldn't. The distributor was one of the 44 companies named in the ban. My contact asked if they could source the material elsewhere. The supplier said they'd try, but lead times were now quoting 6 to 8 weeks instead of 2. And the price wasn't fixed anymore. It was quoted as to be determined upon availability. He told me that if the material doesn't arrive within 10 days, the production line shuts down. That means furloughs. That means missed contracts with their own customers. That means penalties. He said his CFO asked him if they should just pay whatever it costs to get the silver. He said he tried. He called 5 different suppliers. 3 didn't answer. 2 said they couldn't guarantee delivery at any price. That phrase stayed with me. Any price. Because if you can't buy something at any price, it's not a pricing problem. It's an access problem. And access problems don't resolve themselves by waiting for the market to clear. They resolve themselves when someone with authority decides who gets access and who doesn't. Here's where it gets more complicated. Silver doesn't just sit in a vault. It moves. It gets refined, alloyed, fabricated, shipped, re-refined, recycled. The supply chain isn't a straight line. It's a web. And that web relies on a handful of choke points that most people never think about until they stop working. One of those choke points is refining capacity. There are only so many facilities in the world that can take raw or recycled silver and turn it into the purity grades required for industrial use. A large percentage of that capacity sits in China. Another significant portion sits in Europe. If Chinese refiners can't coordinate with distributors, and if European refiners are running near capacity already, where does the incremental supply come from? I reached out to someone in Switzerland who works adjacent to metals refining. I didn't ask for specifics. I just asked if he was seeing anything unusual. He told me that inquiries have spiked in the last 72 hours. People asking about refining timelines. People asking about throughput. People asking if it's possible to jump the queue. He said the answer is usually no. Refining schedules are booked months in advance. You can't just add capacity because someone needs material next week. The infrastructure doesn't scale that way. But he also said something else. He said a few of the inquiries weren't coming from industrial buyers. They were coming from entities that normally don't touch physical metal. Funds, trusts, institutional accounts that usually trade paper. He said it felt like they were suddenly trying to verify that the metal they thought they owned could actually be accessed if they needed it. That shift from assumption to verification is often the first sign that confidence in the system is starting to crack. I don't know what authorities in China are planning. I don't know if this is a temporary measure or the beginning of a longer restructuring. What I do know is that when you remove liquidity providers from a market and then keep the price stable, someone is managing that outcome. It could be state-owned enterprises stepping in to provide the missing bids and offers. It could be algorithmic trading systems that haven't updated their models yet. It could be market makers who are waiting for instructions, but it's not natural, and it won't last. At some point, one of 3 things happens. Either the banned entities are quietly allowed back in under new terms, or new entities are designated to replace them. Or the market fragments and prices start to diverge between what's quoted on a screen and what people are actually paying in private transactions. If it's the third option, that's when things get interesting. Because once price discovery moves off exchange, it becomes impossible to know what anything is really worth. You just know what someone was willing to pay in a specific transaction under specific circumstances. And if those circumstances include scarcity, urgency, or restricted access, the price isn't a market price anymore. It's a rationed price. We've seen this before in other commodities. Nickel in 2022, wheat in 2008, nat gas in Europe in 2021. The pattern is always the same. The official price stays calm, the headlines stay measured. And then one day, someone defaults, or a warehouse is found to be empty, or a contract gets torn up, and everyone realizes the price they were looking at wasn't real, what you should be asking. So here are the two questions I think are worth sitting with. First, if you own silver, where is it? Not where is the contract filed, not where is the account statement, where is the actual metal, and if you tried to take possession tomorrow, what's the process? How long does it take? Who do you call? Second, if the price on your screen hasn't moved, but the people who make that price are no longer allowed to operate, what exactly are you looking at? Are you looking at the value of the metal? Or are you looking at the value of a system that's trying very hard to appear stable while the infrastructure underneath it is being reorganized? I'm not telling you what to think. I'm asking you to think about what happens when the gap between what the screen says and what the world does starts to widen. Because that gap doesn't stay narrow forever, and when it snaps fast. If you've seen something similar in your own industry or your own market, I'd be curious to hear it. Not rumors, not speculation. Just what you've observed directly. Leave it in the comments. I read them. Quiet warning ending. I want to end with something a mentor told me a long time ago. He said the most dangerous phase of any market dislocation isn't when the headline hits. It's the 72 hours before. Because that's when decisions are being made by people who have information you don't. And by the time the decision becomes public, the opportunity to act on it is already gone. I don't know if we're in that 72-hour window right now, but I know what absence looks like. And I know that when the people who are supposed to answer the phone stop answering, it's usually because they're on another call. A call you're not on. A call where someone is deciding what happens next. So watch the silence. Watch who stops talking. Watch what stops moving. Because the thing that isn't happening is often the thing that matters most. I'll be back with another briefing when there's something new to observe. If you want to make sure you catch it, subscribe. And until then, stay sharp.